Right, so let's do this question. Clooney, question 3, December 2010. So let's read the requirements like we always do. Alright, so comment on the matters that you should consider and state the audit evidence that you would expect to find in your review of the working paper. So when you have got a review of the working paper, this one is a review question, a matters to consider, and evidence question. So this one has got a very specific exam technique. So let's go and read the top bit. It says here, Clooney is one of the leading leisure travel providers operating under several brand names to sell package holidays. The company catered for more than 10 million customers in the last 12 months. Draft figures for the year ended 30th September show a revenue of 3.2 billion, a profit before tax of 150 million, and total assets of 4.1 billion. Clooney's executives earn a bonus based on profit before tax of the company. So that's a very important piece of information because it tells you that there's pressure to overstate profits. You're the manager responsible for the audit of Clooney. The final audit is nearing completion and the following points have been noted by the audit senior for your attention. In July 2010, just before the year end, thousands of holidaymakers were left stranded abroad after the company operating the main airline chartered by Clooney went into liquidation. The holidaymakers were forced to wait an average of 2 weeks before they could be returned home using an alternative airline. They formed a group which is claiming compensation for the time that they were forced to spend abroad, with a total claim amounting to 20 million. The items which the group is claiming compensation for include accommodation and subsistence costs, lost income, distress caused by the situation. The claim has not been recognized or disclosed in the financial statements, and that's a very important piece of information. The claim has not been recognized or disclosed. Has not been recognized or disclosed in the financial statement, as management argues that the full amount payable will be covered by Clooney's insurance. So the two things here in this particular question, first of all, there is a claim, a possibility or a probability of a claim amounting to 20 million. And then there's another one where you have got insurance recoverable. They're two separate situations, and according to IS 37, we've got to treat them separately. Alright, then you have got another two paragraphs here which we'll read later. At the moment, what we're doing is we're just dealing with the compensation claim, 8 marks. So the answer format has already been prepared for you. Alright, so now we're going to deal with the materiality of the financial statement item. But the thing down here is that we cannot put anything down here. Alright, we are not going to put anything down here simply because the item is not in the financial statements. Therefore, we are not going to include anything inside here. Alright, so when it comes to the IAS, there are two things here. One is the provision for the claim. Alright, let's have a look. The claim itself, and then the second paragraph here deals with the insurance. So the two parts here. Okay, so the first thing that we're going to consider is to do with the recognition part of things. So here we've got recognition. So according to IS 37, an entity must recognize a provision. You have to recognize. What are you going to recognize? A provision. If and only if all three criteria are met. First of all, there has to be a present obligation, legal or constructive, and the payment is probable. All right. However, in the event that it is only possible, then we are not going to make a provision. You are going to have a note to the financial statements because now it is a contingent liability. All right. So on the area of recognition here, we have got we're talking about IS 37 on the area of recognition. You're going to get 1 mark down there. All right. So then on the area of the insurance claim, again, it's a recognition issue. And we're saying the fact that the compensation, if paid, would be covered by insurance does not mean that the claim should be ignored. So we cannot set off the claim against the insurance. If the reimbursement from the insurance cover is virtually certain, all right, so if it is virtually certain, then the amount receivable should be accrued for. However, if it is less than virtually certain, and here when we are talking about less than virtually certain, we are talking about a situation where it is probable. All right, then a note to the financial statements describing the contingent asset should be provided. Please take note that if it is possible that the recovery from the insurance company is only possible, then we do not even recognize it as a contingent asset. It is not recognized in the notes at all. All right, so what we have here is on the area of the insurance. We talked about the recognition, so there's another 1 mark. All right, so then there is a possibility that there is going to be a misstatement. So let's write that out now. So then you're going to say that the claim of let's go there again. The claim of 20 million represents how many percent of profit before tax and is therefore material or immaterial. So when you do the calculation here, the 20% represents 13.3% of profit before tax and is therefore material. All right, so for getting that, we have got half a mark inside there. So then you've got the next statement, the claim of 20 million represents how many percent of total assets and is therefore material or immaterial. So for this one, we have got 0.5% of total assets and is therefore not material. You get another half mark here. Now the reason why I'm doing 2 calculations here is because for these questions 1 mark has already been pre-allocated for materiality and we did not do any calculation here. So there's no materiality calculation up here, and by virtue of that, in order for me to take advantage of the 1 mark rule, I have got 2 calculations here. So we don't know whether this one is going to be probable or possible. Doesn't matter. The way that we calculate materiality is to look at it as if it was a double entry. So we're comparing it against the PBT and against the total asset. So then the impacts on the audit opinion. Now, there's a lot of information that we don't know here. We don't know whether it is probable or possible. So therefore, we said that if the outcome is probable, all right, and a provision is not recognized, then the opinion will be qualified except for seen that the financial statements are materially misstated due to non-compliance with IAS 37. Alright, so for doing that, we have got another 1 mark. So let's just record it down here. So we've got 1, 2, 3, 4 marks here so far, and 8 marks are given for the whole section, this whole section on the area of the claim. Alright, so what that means is that for the rest of the marks, we'll have to get it under the audit evidence. So how do you go about doing this? So what you can do is, from the question itself, you are going to look at the numbers, whatever numbers that are given. So we are going to find proof of that. The proof of that would already have been obtained, and it would be inside the audit file. So the 20 million having been agreed to the claim made by the group of holiday makers. Okay, then you have got the obligation. So here the obligation is either constructive obligation or a legal obligation. So the first thing we want to do is to look to see whether there's any legal obligation. For the legal obligation, you'll have to go to the contract. So what would you expect to find in the file? I would expect to find standard terms and conditions that the holiday makers agreed to on booking a holiday, having been reviewed to establish any legal obligation. All right. On the other hand, there could also be a situation where there is a constructive obligation. So for the constructive obligation, there has to be some kind of an announcement that has been made. And this announcement will give rise to a valid expectation. So it's very common that, when you watch on TV, when holidays are cancelled, usually the tour operator will come on TV and say that, look, we're going to take care of you, we're going to do this, we're going to do that, we're going to bring you back home safely at no extra cost or whatever. And that announcement is going to give rise to a valid expectation, and a valid expectation will give rise to a constructive obligation, which means that either way, whether legal or constructive, you're going to have to make a provision if it's probable. All right. Then you have got another part here which talks about the probability or the possibility of the outcome. We really don't know whether it is going to be probable or whether it is going to be possible. So the only person who would be able to help us out here would be looking at what the legal representatives, the Clooney's legal counsel, what they're actually saying. All right, so you have got the 20 million there earlier that we've already had a look at. Now we're looking at the compensation from the insurance company. So what do you expect to find in the file? A copy of the correspondence between the insurance company and Clooney establishing whether a claim on the insurance has been made. Okay, so that is the first part. So when you look at the marks here, the marks here are, here is 1 and here is 1, there's 1 here, and there's 1 here and 1 here. And remember, the whole part of this question, there is only a maximum of 8 marks. All right.